Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you still thinking about all the times that you didn't?
It's a new trading day. Welcome to Modern Investing Techniques, episode 37 for May 9th, 2026. I'm Patrick, coming to you from Vancouver. Let's get into the numbers, the strategy, and today's AI-selected trade. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. U.S. sanctions on 11 entities and 3 individuals in Iran, China, Belarus, and UAE target supply chains that could ripple into energy and materials pricing. Markets opened higher, with the S&P 500 at 7,399, up 0.8%. The NASDAQ Composite reached 26,247, gaining 1.7%. The TSX Composite hit 34,078, rising 0.7%. Broad risk on flows supported sentiment despite ongoing geopolitical tensions from the sanctions. Investors should watch for any follow-through volume in commodity-linked names. The Bank of Canada's upcoming December policy calendar could begin to influence CAD crosses. With markets showing resilience despite sanctions, let us review how our last simulated position performed against that backdrop. Last week, we simulated an AMD momentum play on data center growth and AI infrastructure demand after an earnings beat. We entered at $360.31 on Monday's open. We exited at $408.46 on Friday's close. That delivered a 13.36% gain, or $133.63 on a $1,000 position. The trade produced positive alpha versus the NASDAQ over the same 5-day window. Our running total across 15 trades sits at $0.01 with a 47% win rate. The earnings-driven momentum worked because data center demand exceeded expectations and sector rotation supported the move. Yet the results still lagged the broader index in cumulative terms. Rule: always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. That win came from waiting for the right setup. Today, we are applying the same discipline. No qualifying weekly hold setup meets our volume confirmation or technical criteria today. Mortgage rate data shows ongoing fluctuation without an earnings or policy shock to trigger entry. The low confidence environment reinforces patience as an active risk management decision. Skipping a trade when confirmation criteria are unmet preserves capital and reinforces that patience itself is an active decision. Listeners learn to define explicit entry rules in advance rather than forcing action on marginal setups. This is a simulated trade for educational purposes only, while we sit on the sidelines. Here is a proven defensive rotation approach worth having in your toolkit. Sector rotation into consumer staples and discretionary names can be executed by screening for companies with stable free cash flow margins above 8% and dividend growth streaks of at least 5 years. Today's list of top-performing alcohol and camping stocks highlights names that often exhibit defensive cash flow characteristics during periods of macro uncertainty. The approach works by overweighting these holdings inside a TFSA when broader indices show elevated volatility, then trimming once relative strength versus the TSX fades. Implementation is straightforward on Questrade or Wealthsimple. Run a screener for payout ratios under 60% combined with 5-year dividend CAGR above 5%, Then allocate no more than 5% per position. The strategy has historically delivered lower drawdowns than pure growth sleeves during 2018 and 2022 rate hike cycles, though it can lag in strong bull markets. Risks include regulatory changes on alcohol taxation and shifts in consumer spending patterns. That rotation idea pairs naturally with understanding how Canadian dividends are actually taxed. Imagine you bought a Canadian bank stock inside your TFSA last quarter, expecting the dividend to compound at a 4% yield. Your brokerage shows the cash hitting the account, but here is what actually happens between the declaration date and the deposit. The eligible dividend receives the gross up and dividend tax credit treatment that only applies to Canadian corporations, turning a 4% headline yield into an after-tax equivalent closer to 5.3% for someone in the 40% marginal bracket. The mechanism works because the dividend tax credit offsets the gross up at both federal and provincial levels, a feature unavailable to U.S. dividends or REIT distributions. What most retail investors do not realize is that the credit is only available on eligible dividends from Canadian companies that pay tax at the full corporate rate, so checking the issuer's tax status on SEDAR Plus before purchase avoids surprises. The professionals always verify free cash flow coverage above 1.2 times the dividend before committing capital, rather than chasing headline yields above 7%. The biggest mistake with Canadian dividend investing is loading up on high-yield names without confirming payout sustainability. Instead, always screen for dividend aristocrats on the TSX that have raised payouts for 10 or more consecutive years, and keep the position size under 8% of the TFSA to maintain diversification. To execute these screens efficiently, let us look at two practical tools. The Benzinga Pro Stock Screener lets users filter for top-performing sector stocks using real-time volume and relative strength metrics. It gives individual investors the same institutional-grade scanning power previously limited to hedge fund terminals. Canadian TFSA users running weekly screens for dividend growth, names, or momentum setups should start with the free tier and upgrade only after testing 3 saved scans. The Benzinga Pro Forex Analysis tool provides technical overlays and macroeconomic variable forecasts directly inside the trading workflow. It helps retail traders quantify cross-asset signals before executing any currency hedge equity position. Users on Interactive Brokers or Questrade can export the output into their own spreadsheets for correlation checks. Before we wrap, here are the fastest moving headlines you should have on your radar. U.S. sanctions raise energy and material supply concerns, so hold CAD cash for now with no rotation signal yet. Cellulose Irani posted a Q1 2006 earnings miss, but outlined expansion plans, creating a potential mean reversion setup in materials. Add it to your watch list for Friday close if volume exceeds the 20-day average. HFCL posted strong Q4 2026 earnings growth with revenue and margin expansion that could support further rotation into industrials. Trim precious metals exposure if gold closes below recent support. Kremlin signals keep the geopolitical risk premium elevated in energy and defense holdings, so avoid adding Canadian REIT exposure this week. Open your brokerage screener and filter TSX listed financials for payout ratios below 55% and 5-year dividend growth above 4%. Add the top 3 results to a dedicated watch list and note their current distance from the 50-day moving average. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.